Welcome back to Storm Stock Solutions. I'm Grant Mercer, and the closing bell has just sounded on Wall Street. Let's bring some clarity to the chaos of today's tape. We wrapped up a session where the big story wasn't a huge move in the major indices, but a brewing tug-of-war between policy uncertainty, missing data, and some violent action in commodities and select pockets of tech. Underneath the surface, traders are clearly repositioning for a more volatile few weeks. Let's start with the upside story because there actually is one. According to reporting from MarketWatch, the January U.S. jobs report is being delayed again due to the partial government shutdown. On the surface, that sounds like a negative, but markets treated it more as a stay of execution than a shock. A delayed report means no immediate data surprise on Friday, and some investors see that as buying time for the Fed and for risk assets. As Jeffrey Bartash notes, the street still expects to get key labor market insights from private surveys and other indicators, so this is more about timing than a total blackout. For rate-sensitive sectors and growth names, the absence of a big payrolls headline this week removed one near-term landmine. You could see that in some of the tech growth stories picking up attention into the close. Philip Van Dorn at MarketWatch highlighted a group of software names, ServiceNow, Shopify, Twilio, as standouts in what's been a beaten-down corner of the market. The tone there is important. The argument is that the long-term upside could be large, potentially 50 to 75%, based on some analyst targets. But there's still a debate about whether it's too early. Traders are watching this as a potential green shoots moment for high-quality software, not an all-clear signal. In other words, strength is emerging, but it's still fragile and very selective. On the downside, the pain trade today was in precious metals. Gold is now down nearly $1,000 from its peak, and silver is extending losses after what Myra Safong and Barbara Kallmeyer describe as a record 31% one-day slump, its biggest daily drop in 46 years. That's not your garden variety pullback, that's a liquidation event. The failure to rebound meaningfully today tells you that some leveraged, late-to-the-party money is still being forced out. These are areas to handle with care right now, because forced selling and margin calls can overwhelm fundamentals in the short term. Mark Hulbert added another layer, arguing that gold investors, even after this plunge, may still be too bullish by historical sentiment measures. If that's right, it suggests the repositioning in the metals complex might not be done. For equity folks, this matters because gold and silver had become popular hedges and speculative trades. When they unwind this violently, it can ripple through miners, related ETFs, and even cross-asset risk models that use metals as part of their defensive basket. Stepping back to the bigger macro picture, the other name hanging over the market is Kevin Warsh. Reporting by Jai Kedia underscores the challenge. Warsh is expected to keep the Federal Reserve out of day-to-day politics, even as pressure ramps up from the White House on ballot box issues. The concern for markets is that if policy is seen as leaning too political or too unpredictable, it injects a risk premium into everything from bonds to equities. Hardika Singh also points out that Wall Street still can't get a handle on Warsh's reaction function. Until traders understand how he'll respond to inflation, growth scares, and political noise, they're bracing for a bumpier ride. That uncertainty tends to favor more defensive, cash flow-heavy sectors and can limit how far valuations can stretch in the high-growth corners of the market. Now, in the background, there are a couple of under-the-radar stories I'm keeping on the watch list. Vivian Liu Chen reports that the bond market is laser-focused on one thing in Wednesday's Treasury refunding announcement: any sign that the government is going to significantly increase the size of future note and bond auctions. If Treasury signals bigger supply, that could push yields higher and rattle both bonds and stocks. It's not front page for most retail investors yet, but for professionals, refunding days can set the tone for weeks of trading in rates and, by extension, growth versus value. Outside of pure markets, there are also personal finance and estate planning stories, like the piece on a family dealing with a $500,000 theft from an ailing father, that, while not moving the S&P, highlight the ongoing need for solid planning and safeguards. Those are the kinds of issues that don't show up in intraday charts, but matter a lot for real-world wealth. Looking ahead to tomorrow's session, here's what I'll be watching. First, any follow-through or lack thereof in precious metals. Do we see stabilization and real dip buying, or does the selling spill further into miners and broader commodities? Second, how growth tech behaves, especially software and high multiple semis. There's another MarketWatch piece flagging Micron's chart as ominous, with the stock stretched far above its long-term trend by historical standards. Traders will be asking whether that kind of extension in chips is a warning sign or just another leg in the cycle. Finally, anything we hear on the jobs data workaround and more clarity on Warsh's policy leanings will matter. With a delayed payrolls report and a market still trying to map a new Fed chair, every speech, leak, and data proxy is going to be scrutinized. We'll dig into all of that for you in tomorrow's pre-open update so you're ready before the bell. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.